Share-based payments. What is share-based payments? It is when an entity receives goods or services from the supplier or employee in a share-based arrangement, or incurs an obligation to settle the transaction with the supplier in a share-based payment arrangement when another group entity receives those goods or services. Introduction. A corporation may issue its own shares in exchange for non-cash consideration, such as non-cash assets or services. The only requirement under the Corporation Code of the Philippines is that no share shall be issued in exchange for promissory notes or future services. The consideration must be received first. If, in the form of services, the services must have been rendered first before shares may be issued. Furthermore, the value of the consideration received should not be less than the par or issued value of the shares issued.
Things to know. There are no exceptions from application of PFRS2, except for transactions with owners of the entity. A transaction with a party acting in his or her capacities as owner is not a share-based payment transaction.
Scope. Equity-settled share-based payment transaction is a transaction whereby an entity acquires goods or services, and instead of paying in cash, the entity issues its own shares of stocks or share options. Cash-settled share-based payment transaction is a transaction whereby an entity acquires goods or services and incurs an obligation to pay cash at an amount that is based on the fair value of its own equity instruments, or choice between equity-settled and cash-settled is a transaction where an entity receives goods or services and either the entity or the counterparty is given a choice of settlement in the form of equity instruments or cash based on the fair value of equity instruments.
Things to remember.
Measurement date is the date at which the fair value of the equity instruments granted is measured for the purposes of PFRS2. For transactions with non-employees, the measurement date is the date when the entity receives the good or service. For transactions with employees and others providing similar services, the measurement date is grant date. Grant date is the date at which the entity and the counterparty agree to a share-based payment arrangement, being when the entity and the counterparty have a shared understanding of the terms and conditions of the arrangement.
Summary of initial measurement. For transactions with employees, goods or services acquired for non-employees are measured using the following order of priority. 1. Fair value of goods or services received at measurement date. 2. Fair value of equity instruments granted at measurement date. For transactions with employees and others providing similar services, goods or services acquired from employees and other providing similar services are measured using the order of priority. 1. Fair value of equity instruments granted at grant date. 2. Intrinsic value.
Share-based compensation plans. Share-based compensation plan is an arrangement whereby an employee is given compensation in return for services rendered in the form of the entity's equity instruments or cash based on the fair value of the entity's equity instruments or a choice of settlement between equity instrument and cash. Share-based compensations are given to key employees as bonuses or additional compensation. Examples of share-based compensation: employee share options, equity settled; employee share appreciation rights, cash settled; compensation plans with a choice of settlement between 1 and 2 above.
Recognition of equity or cash-settled share-based compensation plans. If the share options granted vest immediately, for equity-settled, salaries expense shall be recognized in full with a corresponding increase in equity at grant. For cash-settled, the entity shall recognize the related compensation expense on the services received in full with an increased liability at grant date. If the share option granted do not vest until the employee completes a specified period of service, the entity shall recognize the services received. For cash settled, as the employee renders service during the period. For equity settled, over the vesting period. Vesting period and condition. Vesting period. the period from the grant date to the date on which the share options can be first exercised. Vesting condition. It determines whether the entity receives the services that entitle the counterparty to receive cash or other equity instruments. There are two kinds of vesting conditions. First, service condition. The grant of equity instruments is conditional on the employee remaining in the entity's employ for a specified period of time. Second, performance condition. The grant of equity instruments is conditional on the accomplishment of a pre-agreed performance. A performance condition may be non-market vesting condition, such as the entity achieving a specified growth in profit, or market vesting condition, such as the attainment of a specified increase in the entity's share price.
Illustration. On January 1, 20X1, ABC Corporation grants 10,000 share options to its key employees to purchase 10,000 ordinary shares of ABC with par value of 100 pesos and a fair value of 120 pesos. A grant date for 110 pesos per share. The share option have fair value of 15 pesos per share option. The share options are exercisable immediately. All the share options were exercised on July 1, 20X1, when the ordinary shares are selling at 150 pesos per share.
Salaries expense is computed as follows. January 1, 20X1, fair value of share options at grant date, 10,000 share options times 15 peso per share option, which give us the amount of 150,000. We will multiply it by vesting period passed over total vesting period, which we will ignore it, which that will give us the total amount of salaries expense 20x1, which is 150,000. To enter this amount, we will debit salaries expense 150,000, credit share premium share options outstanding 150,000. The fair value of the share options is recognized as a compensation expense at grant date, which is its grant date is January 1, 20x1 because the share options vest immediately. The fair values of the share are ignored, which is the fair value of 120 pesos at grant date for 110 pesos per share. To entry the exercise share options, on July 1, 20x1, we debit cash on hand 1,100,000, credit share capital 1 million, share premium 100, which is the difference between the cash on hand and share capital. On the same date, we debit share premium share options outstanding 150,000, credit share premium 150,000. Observe that the share premium from the share options outstanding transferred directly in equity at exercise date. Prior to exercise date, the share options outstanding forms part of total share premium.
Illustration. On January 1, 20X1, ABC Corporation granted 1,000 share option to each of its 100 key employees conditional upon each employee remaining in the ABC's employ over the next 3 years. ABC estimates that the fair value of each share is 15 pesos. On grant date, ABC estimates that no employee will leave the company during the 3-year service period. During the 3-year service period, no employee have actually left the company.
Salaries expense are computed as follows. For December 31, 20x1, the number of share options granted per employee, 1,000. We will multiply it by the number of employees expected to remain in service, which is 100, which give us the total share options expected to vest, 100,000. We will multiply it by the fair value per share option at grant date, which is our grant date is January 1, 20x1, 15 pesos. That will lead us to fair value of share options at grant date 1,500,000 pesos. We will multiply it by vesting period passed over total vesting period, which is 1 year over 3 years. It will give us the amount of 500,000, which is it is the cumulative salaries expense to date. We will deduct it by the salaries expense recognized in previous periods, which is zero because there is no previous period. And then the salaries expense for 20x1 is 500,000. For December 31, 20x2 to December 31, 20x3, we will use the same amount of fair value of share options at grant date because we will assume that there would be no employees leave the company during the year 3 service period. Then, since the fair value of share options at grant date is 1,500,000, we will multiply it by vesting period passed over total vesting period 2 years over 3 years, which lead us the amount of 1 million, which is the cumulative salaries expense to date. We will deduct it by the previous periods, which is 500,000. And it will give us the salaries expense for that year is 500,000. For December 31, 20x3, fair value of share options at grant date 1,500,000. We will multiply it by the vesting period passed over total vesting period, which is 3 years over 3 years, and it will lead us to cumulative salaries expense to date 1,500,000. And we will deduct it by the previous period, which is 500,000 plus 500,000 is equals to 1 million. Give us the salaries expense 20x3 500,000. For the entries are as follows. For January 1, 20x1, we will give the memo entry, which is the granted 1,000 share options to 100 key employees on January 1, 20x1. Fair value per share option on January 1, 20x1 is 15 pesos. As of December 31, 20x1, we debit salaries expense minus share options 500,000, credit share premium, share options outstanding 500,000. As of December 31, 20x2, we debit salaries expense, share options 500,000, credit share premium, share options outstanding 500,000. Lastly, for December 31, 20x3, we debit salaries expense, share options 500,000, credit share premium, share options outstanding 500,000.